What a turnout. It is so nice to see so many familiar faces. What a great morning. So hi, everybody. My name is Ali Spinner, and I am chair of the Jewish Foundation's Professional Advisory Committee, also known as PAC. Thank you so much for joining us today at our PAC seminar, Professional Planning for 2024, 6 essential tax, legal, and financial topics. Today's program aims to provide valuable knowledge and interesting discussions, and we hope that you will leave here feeling well-versed in the topics that are covered. I'm sure that you will. First, I'd like to thank our lead sponsor, Pear Tree Canada, thank you, and of course our breakfast sponsor, Richter, both for their ongoing support. Thank you. In addition to our regular program, we are also going to be hearing from Steve McDonald, UJA's VP of Communications and Marketing, regarding the situation in Israel and how the Toronto community continues to provide support. I've heard Steve speak before. He's excellent, and I know that we're all eagerly waiting his presentation. The Jewish Foundation plays an integral role in our community by providing fund holders with the opportunity to make lasting contributions to charitable organizations that are important to them. In doing so, all of the fund holders strengthen our community. The Jewish Foundation wrapped up its fiscal year on June 30th, 2023, and what a successful financial year it was. We closed out the year with $772.6 million in assets under management. We had almost $52 million distributed to charitable causes throughout our community. The returns were actually quite amazing. We received an 11.8 investment return for the year. And with approximately 1,700 funds, so many community members are working with the Jewish Foundation to fulfill their charitable goals. A material part of the success of the Foundation can be attributed to those in the room, professional advisors. Many of you who are very active in the Foundation are here today. By incorporating philanthropy and philanthropy discussions with your clients in your practice, you offer something very important to your clients. And when partnering with the Jewish Foundation, you can help your clients fulfill their philanthropic goals and objectives, often in a tax-efficient manner, in a way that takes their life and financial circumstances into account. This benefits everyone involved. I encourage you to speak to myself or any member of the Professional Advisory Committee or the Jewish Foundation staff to learn more about this opportunity of how we can work together. One important way that the Jewish Foundation makes charitable giving easy and rewarding is through our donor-advised funds, or DAFs. DAFs are formally structured vehicles for charitable giving that enable donors to recommend which initiatives and charities will receive their donations each year. When I talk about philanthropy, and I do talk about it a lot, DAFs can also be a wonderful vehicle when considering the timing of when tax receipts and making tax-efficient gifts are made. For more information on DAFs or how your clients could benefit or yourselves can benefit, take a look at the brochures on your table. And my final item of business before we get started is to present the 2023 Professional Advisors Award of Excellence. Each year, the Jewish Foundation awards one community member with this prestigious award, recognizing their outstanding and active contribution to the Foundation as a community professional. The individual selected for this annual award must exemplify the highest professional standards and shall have made a contribution in one or more of the following areas: assistance in structuring gifts to the Jewish Foundation, promotion of estate planning for charitable giving in their professional expertise, and volunteer involvement or consultation with the Jewish Foundation or UJA Federation. And this year, I am so pleased to announce that we are honoring Saul Plenner. Saul, you can start to make your way up as I talk about your achievements. Saul is the current PAC Vice Chair and has been a dedicated advisor for many years. He started on PAC in 2015 when he was a partner at PwC. Paul served as PwC's National Managing Partner of Strategy and Operations, their National Tax Leader, and their National Private Company Services Leader. He has consistently referred clients to the Foundation, has facilitated presentations with Foundation staff on tax-efficient giving, and has been a tremendous source of support and information in providing his expertise with respect to structuring gifts. He strongly believes that we can all make a difference in our community and that promoting the Jewish Foundation as a way to make financially sound philanthropic gifts was one of the most enjoyable parts of his job. Mazel tov, Saul. Okay, I would now like to introduce Ron Birnbaum, founder and CEO of Pear Tree Canada, our lead sponsor, to say a few words. Come on up, Ron.
Thanks, Ali. In philanthropic circles, it's really simple. You write a check, you get to speak. No one has to listen. But I promise you, you don't have to listen for more than 2 minutes. First of all, on behalf of ourselves and our friends at Richter, who are also sponsoring this morning, we'd like to express our appreciation and thanks to the great work that the Professional Advisory Committee does, the tireless efforts by Ali and the crew in bringing a level of professionalism to philanthropic causes and to the community more generally. I've said this before. One of the reasons we are sponsoring is a sort of a sense of continuity, and in our community, we've talked a lot about sustainability and continuity in our community over the last month or so. I was at the very first PAC meeting in 1979. I was a freshly minted lawyer. It was at the Beth Emeth. It was a very large crowd, and Ronnie Appleby was the chair. For the many people in this room who were at the Negev dinner earlier this year, Ronnie Appleby is still a chair of Jewish organizations. He was still there, and he was co-chairing that event as well. I am only reminded, I just want to share one small story that has nothing to do with our business, and that is my 87-year-old brother, Marty, remembers in the late 40s accompanying our dad and brother-in-law as they took boxes down to Union Station to send off to Europe to the displaced camps where some of the cousins had survived the Shoah. And on one occasion during the summer, they were dropping off the boxes, and one seemed very light. And my brother remembers how the two of them opened the box, looked inside, felt there just wasn't enough, took the shirts off their backs without saying a single word. They just looked at one another, took the shirts off their backs, and added those shirts to the box and resealed it and sent it off to Europe. And I think we're in the same position today. I think it's time to take the shirts off our backs, and limitations on AMT that we have discussions all the time, I don't think count this year, carry forward into your return, and Jamie will be talking about that a lot. The one housekeeping comment is a lot of people in the room have already asked me whether the donation of flow-through shares will end this coming year with the increase with the changes in AMT, and the bottom line reality is, all other factors being equal, if you're using this format, whether from us or from others, the likelihood is that if your income remains the same and nothing else changes, you'll be able to give about a third less. But it's not dead; it's just modified, and the market will change, and the premiums will come down, and it'll be, but it won't be any worse than about a third. On that note, that's all I have to say, and thank you so much for all the work that the committee is doing. A special thanks to Robin Turek, who has served on the committee on our behalf for so much. And on behalf of Richter's and ourselves, I'm delighted to be sponsoring this again, and hope to speak to you again next year. Thank you.
Thank you again to Pear Tree for all of your support. I'm now going to introduce Steve McDonald, UJA's Vice President of Communications and Marketing, to provide a brief update on the situation in Israel and how the Toronto community continues to provide support. Come on up, Steve.
Good morning, everyone. First, I just want to thank everyone for being here, and really to thank you all for everything you're doing to support the people of Israel at this time. I know so many of you have had conversations with philanthropists or with each other over the past month, and this is one of those crises in the Jewish world that I don't think any of us expected to see in our lifetime. But I also know that this community is stepping up in an extraordinary way. We've seen in Israeli society that all of the things that seemed to matter on October 6th, all the political divisions, all the religious divisions, the divisions between Jews and Arabs, all of these things faded on the morning of October 7th. We've seen the entire country come together to help each other and to take care of each other, and really to mount a war effort unlike anything that Israel's seen since 1948. And just as we've seen that unfold in Israel, we've also seen this community step up in every possible way, whether it's donors, whether it's volunteers, whether it's professionals. There's something very special that takes place here in Toronto, and I just want to frame my remarks around that first. On my wall in my office, you'll see framed a number of old editions of the Canadian Jewish News. And you'll see in particular there's a couple from 1967. And one of the headlines in June of '67 makes the point that Toronto at that time had raised $9 million to help with the war effort in Israel. And at that time, Toronto was the city in North America that had the highest fundraising total. And if you look at what's happened in the past month, we're really living up to that legacy as a community. Within 36 hours of the attacks taking place, we launched an emergency campaign. Within 48 hours, we also launched a rally that brought 20,000 people out to show our support for Israel. And in less than a week of launching that emergency campaign, we were able to send over our first emergency allocation to Israel. And to this date, we've now raised over $72 million, which is truly extraordinary. And when you step back from this immediate issue, you know, I've worked for the community for 13 years now, 4 of which were here at UJA. And in those 4 years, I don't think I would have encountered as many kind of whole of community crises as we've seen in the past 4 years. Within 6 months of starting, we had the COVID crisis. Within another year of that, we had a war in Israel in May 2021, which was ferocious and led to a lot of anti-Semitism domestically. And then a year later, we had the Russian invasion of Ukraine. And the fate of the Ukrainian Jewish community was hanging in the balance. And now we have this current situation. And when you think about all of these crises, and you look at what we need to do as Jews to deal with it, you realize that it's moments like this where you absolutely need a strong, central, whole-of-community organization like UJA, and a vehicle like the Foundation to enable philanthropists to make an impact. Because if you want to fight a fire, you can't build a fire station as soon as the fire starts. You need a pre-existing infrastructure in a community like ours to ensure that as many people as possible can donate, whether it's donating their time or donating financially, and so that the dollars can flow in a way where you can trust that it's making an impact on the ground. So I'm going to take just a few minutes to talk about that in the context of the current Israel crisis. I'm sure everyone here will have seen the regular reports we've been issuing on the grants we've been making. To this point, we've made 18 grants totaling $17.96 million. This is the first wave of funding that we've issued, and it's focused very much on immediate needs. And there are a number of immediate needs in the region. So just to give you all a degree of context, though I know many have been following it closely on the news sites, southern Israel today is unlike anything it was on October 6th. You have roughly 150 to 200,000 people who are dislocated within Israel. So think about this for a moment. The state of Israel, which was created to a certain extent to be a safe refuge for Jewish refugees from around the world, now has internally displaced Jewish refugees, which is something we never thought we'd see again since the days of 1948. And so you have 150 to 200,000 people who've been dislocated. On top of that, you have thousands of families that are immediate victims of terrorism and tens of thousands more that are traumatized because of what they've experienced. So when we look at the immediate needs, our strategy for making an impact with dollars is really about a few core principles that apply even outside of a crisis period. The first is that we work with partners on the ground who were there long before the crisis began and will be there long after it is done. And so many of you will know that we have a partnership with the community of Sderot. We also have a partnership with the community of Eilat. And if you look at what's happened in Sderot is essentially a ghost town right now. Population of about 35,000 people is almost entirely evacuated, and many of them have ended up in Eilat, which is far from Gaza on the southern tip of Israel. And so just as we have one UJA partner community that's borne the brunt of the ground attack on October 7th, we have another UJA partner community that's doubled in population just in the past few weeks because of all the evacuees that are being hosted. And so the immediate allocations we've made have been focused on things like supports for first responders, non-military, non-police first responders, such as medics, such as emergency mental health professionals, who are based in these communities along the Gaza border and have been working with residents and are continuing to work with them as they've been evacuated. We've also been applying funds to aid victims of terror. So in the first week of the conflict, the Jewish Agency had identified 4,000 families in Israel that are victims of terror. That means either their home was rocketed, they have a loved one who was murdered, a loved one who's held hostage, or someone who's in the hospital. Immediate victims of terror. The total national count in the first week was 4,000 families. Toronto paid for direct payments to 2,000 of those families, just Toronto, which is an extraordinary statement of the kind of impact we're making. And so in addition to providing direct payments for victims of terrorism, we also are providing significant provision of supplies and social services to the hundreds of thousands who have been evacuated. So when you go to Eilat today, the entire community has been shifted in its focus to helping the evacuees, whether it's getting their kids into school, whether it's providing clinics and medicine for people who had to flee their homes with literally nothing, and providing clothing, providing accommodations. All of these things in a community of 60,000 people for 60,000 evacuees is a massive, massive order. So we've been investing in a number of NGOs who are on the ground to provide those kind of services and ensure that these families who've experienced devastating hardship at least have some sense of normalcy while the war continues before they can head home. And of course, you can read in the report, we have a whole bunch of other allocations that we've included, whether it's United Hatzalah, whether it's Zaka. We're talking about first responders who are on the front line, who again, their people are experiencing things we never thought they'd have to experience, and yet they're there to help Israelis and to do the terrible work of recovering bodies, for example. So we're funding all of these interventions. Again, I won't detail everything because you can see it in our updates that we put out. But I just want to really emphasize that we don't see this as simply a one-month problem. Even if, God willing, this thing were resolved in the next few days, which I don't think anyone's expecting, we see this as a challenge that's going to require a multi-month and probably multi-year rebuilding process. We are going to be there the entire time. Our annual campaign regularly funds many initiatives in Sderot as well as in the Gaza envelope area. We are going to continue to support even beyond the emergency campaign because we know that the needs are going to persist. And I don't think any of us are under any illusion that Israeli society is traumatized, and we're feeling that here. And so in addition to all of these efforts that we're undertaking in Israel, I also want to reassure people, and this could be the topic for a future meeting perhaps, that we have also mounted a significant effort to cope with the impact here in Toronto, whether it's the impact of rising anti-Semitism and what we need to do to secure our community. And again, there are a number of things underway, especially in the area of community security, but also in the area of just taking care of people here who are directly affected. We have more than 700 Israelis who are temporarily staying in the GTA. We're providing them with services. We're helping them with temporary housing. We've gotten nearly 200 of their kids into our day schools temporarily. So we're undertaking a whole bunch of things, not just over in Israel, but also here in Toronto to ensure that we do what UJA does best, which is to mobilize the full resources of the community, the educational institutions, the social service institutions, our partners on the ground in Israel. All of these things together are really how we make the biggest possible impact. And so with that, I just want to close by how I started, which is to thank you. People in this community make decisions because of the people in this room. They seek your guidance, and you really are incredible partners for us in ensuring that we're able to bring out the very best in our community at this time. So thank you very much for everything you've done and for everything you'll continue to do.
Steve, thank you so much for that update. And on behalf of everyone here, thank you to you and all of the UJA and Foundation professionals for everything that you're doing to help Israelis in need and the Toronto Jewish community. As we head into our keynote address, I would like to remind you that after each speaker's presentation, there's going to be 5 minutes to answer questions. There are 2 microphones that are going to be circulating throughout the room. If you have a question, please raise your hand, and a Jewish Foundation staff member will bring the microphone to you. And now, the moment we've all been waiting for, our economic update with Benjamin Tal. Benjamin Tal is the managing director and deputy chief economist at CIBC World Markets. He doesn't need any introduction. We all know who he is. Thank you.
Hi, good morning. I must admit it's a bit difficult to focus on the economy, interest rates. I have other things on my mind, like you. But we'll try and see what makes sense and what doesn't, and see what makes sense and what we can say about this economy at this point in time. So I have about 20 minutes to tell you everything I know about the situation. That's 19 minutes too long, quite frankly, because Nobody has a clue. We all make it up as we go. You know that. So I'm going to divide my brief presentation into 3 parts. The first part will be about inflation. The second part will be about inflation. And the third part will be about inflation. And after talking about inflation for 20 minutes, I will tell you at the end of the day, this is not about inflation. This is about the cost of bringing inflation down to 2%. The Bank of Canada, the ECB in Europe, the Fed in the US, they have all established their reputation as inflation fighters. They are not going to toss it away. They will do whatever it takes to bring that inflation to 2%. Now, we can argue until we are blue in the face to what extent 2% is the right number. I don't think it's the right number. I think 3 is the right number. Regardless, they are not going to change this number. For this, they have to see like 500 PhD theses to convince them. It's not going to happen anytime soon. So we are stuck with 2%. So that's the target. So this is a biased bank. Whenever you think about interest rate, think about the fact that the Bank of Canada is biased. You give them 2 options, a recession versus inflation. They will take a recession any day. This means that they are overshooting. Every economic recession over the past 30 years was helped, if not caused, by monetary policy error in which central bankers raised interest rates way too much. And we are in the midst of one. If the Bank of Canada was an AI machine, they would have stopped 50 basis points ago. So they are overshooting, and maybe they know that they're overshooting, because they would rather overshooting as opposed to undershooting, because they know how to deal with recession, they don't know how to deal with inflation. That's the bias. Now, I know that many of you by now are very disappointed because everybody promised you a recession, and we didn't get one. Let me tell you that we are in a recession. GDP growth is basically 0. Basically 0. Over the past 6 months, the economy did not grow. If you look at confidence among businesses, basically recessionary territory. Business openings, negative, going down very quickly. The mortgage market, the real estate market, is in a recession. In fact, the real estate market, we'll talk about real estate later, is now facing the most significant test since the 91 correction. Not 2008. This is worse than 2008. It's the 91 recession. That's the test that we are facing. We see listing rising, but sales down. We'll discuss. The mortgage market is a shadow of its former self, falling at a rate we haven't seen in generations. This is a housing market that is in a recession. And the economy is basically in a per capita recession. Per capita, GDP is down by 3%. Per capita, consumption is down by 2%. So this is a recession, if you measure it correctly. The only reason why we are still above 0 globally in terms of GDP is because of the fact that we got 1.2 million people into this country. This is not a way to grow the economy. You need to see per capita productivity rising. So the fact that you have more people, India also has a lot of people. You need to see per capita GDP rising. That's not happening yet because productivity is 0. So we are basically in a recession, and we'll see where it takes us, and we'll continue. Now, what's the problem is, this is the problem. CPI is still elevated. And the question is whether or not the Bank of Canada will continue to chase that CPI. I think that overshooting happens because of the simple fact that inflation is a lagging indicator. Inflation is telling you about the past, not the future. But show me the central banker that will have the guts to stop raising interest rates when inflation is still elevated. And that's more or less where we are. So let's discuss. First of all, why didn't we get a full-scale recession? Because of this, the consumer. This consumer was loaded, past tense, was loaded. We had a situation in which during COVID, people got their salary, most people, or checks from the government. There was nothing to spend on, So people accumulated $165 billion of excess savings in checking accounts. Now, this savings is basically zero. So in the past, when the Bank of Canada was raising interest rates, it was neutralized by the fact that people were spending their savings. Now there is nothing to spend anymore, it's zero, and people are rediscovering their plastic. Credit cards is back in fashion. So we are accumulating more debt, not savings, and therefore the buffer that was protecting the Bank of Canada from impacting the market is no longer there. Therefore, the Bank of Canada is now more powerful in its ability to do so, and this is a very powerful Bank of Canada. In fact, it is the most powerful central bank in the G7 because of two reasons. One, in the US, they have 30-year mortgages. We have 5. So whenever we raise interest rates, immediately 20% feel the pain immediately. There, it takes forever. Second, you have to go back to 2008. The mother of all recessions in the US led to the mother of all deleveraging. Their debt-to-income ratio went down dramatically. Canada, 2008 was not our recession. We were basically second-hand smokers back then. No, really. So we had a situation in which the Bank of Canada was unable to deal with the situation because we were not really impacted by that. So our debt level went up. So we are more sensitive to higher interest rates. How sensitive? I estimate that 1% increase by the Bank of Canada is equivalent to 2% increase by the Fed. And that's why the Fed has to go higher than the Bank of Canada. Now the Fed is stopping, the Bank of Canada is stopping, we'll talk about it. The spread is only 25 basis points. Usually it's 50 basis points or 75 basis points, which means that one is either undershooting or overshooting. I say we are overshooting. The Bank of Canada is overshooting at least by 50 basis points. Now, and that's, by the way, the reason why inflation in Canada is falling the fastest, maybe too fast. And the damage is too high, especially in the housing market we'll discuss. Given this background, we are now ready to discuss that inflation. I think that the major inflationary forces that we have seen so far are turning slowly but surely into disinflationary forces, all of them, with major implications for interest rates, mortgage rates, and the housing market. First of all, commodities. I think we have to remind ourselves that inflation is a rate of change. We all go to the supermarket. We are all overwhelmed by the fact that food prices are so expensive. We go crazy. The Bank of Canada does not care. Not because they're not nice guys, but because of the fact that what they care about is the rate of change, not the level of prices. Namely, if food prices went up last year by 8%, and today they are rising by 4%, that's disinflationary, despite the fact that the level is very, very high. And we feel it on a daily basis. It doesn't make any difference as far as the Bank of Canada is concerned. So we have a situation in which commodities are actually disinflationary, even energy. The reason why we are getting good numbers now is because of the fact that gas prices are going down. So inflation is impacted in a negative way, which is a good thing, by the commodity market. That's one thing. Then you have supply chain. Supply chain is huge when it comes to inflation in 3 ways. First of all, it's back to normal. Today in the US, you have 20% more truck drivers than before the pandemic. You can see from the chart to the left, supply chain, back to normal. This has 3 implications. 1, clearly, goods prices are not going up anymore. In fact, they're going down because supply chain is not an issue. The other is that during COVID, when supply chain was an issue, 80% of the inflation that we got was from outside, was supply, not demand. The Bank of Canada is impotent in its ability to deal with the situation when the inflation is coming from supply. Believe me, Putin does not care about the fact that the Bank of Canada is raising interest rates. So we were raising interest rates. It was not impacting inflation because it came from outside. Today, with supply chain back to normal, 80% of inflation is coming from where? Inside, domestically. More sensitive to higher interest rates, the Bank of Canada is more powerful. But then we have another factor. profit margins among retailers. Let's face it. Many retailers during COVID took advantage of supply chain. They were hiding behind the fog of supply chain. You went to the store, you asked for this dishwasher, and they said, supply chain, China, Russia. But if you add a little bit more, we'll find one for you in the basement. Look at this. There was 97% correlation between supply chain and profit margins. Today, nowhere to hide anymore. Supply chain is back to normal, and margins are approaching zero. This is a major underrated disinflationary force that we have to take into account. So 3 major inflationary and disinflationary forces unfolding when it comes to supply chain. The effectiveness of monetary policy, goods, and clearly profit margins. But then you have real estate. That's an issue. Shelter inflation is 1/3 of the CPI. And when it comes to shelter inflation, it's not house prices. It's rent, it's commissions to real estate agents, but the most important item, the biggest one by far, is what? Mortgage interest payments that are now rising by 30% a year. So think about it for a second. The Bank of Canada is raising interest rates to fight inflation. Higher interest rates are adding to inflation vis-a-vis higher mortgage interest payments. You see how crazy it is? It's like putting a humidifier and a dehumidifier in the same room, let them go at each other. It doesn't make any sense. Nobody will be able to convince me that higher mortgage interest payments are inflationary. They are disinflationary. We are all paying more interest, which means that we are paying less for something else. That's disinflationary. Still, the Bank of Canada is using these metrics as a way to measure inflation. 1/3 of the index is shelter, and the biggest part is mortgage interest payments. And because of higher interest payments, people cannot buy, so rent is rising by 7-8%. Because of the fact that interest rates are rising. By its own action, the Bank of Canada is influencing inflation. Just for fun, what will happen if you remove interest payments from the calculations? Just for fun. Oh my gosh. We are already at 2%. That's why we are overshooting. We are measuring it in a different way, in a way that makes sense, and all of a sudden inflation is lower than perceived. I'm not saying that inflation is not an issue. It's still an issue. Service inflation is still sticky. And 80% of the cost of services is what? Wages. So you want to have a narrative about interest rates, you want to have a narrative about mortgage rates, you must have a narrative about the labor market and wages. And I suggest that the labor market is normalizing big time. We were talking a lot about those vacancies. 1 million vacancies, you cannot find help, all this business. I never believed that story. I thought it was a bit of a mirage. Why? Because in Economics 101, the only thing I remember is that if you have a shortage of something, the relative price of this something will rise. Namely, if you have a shortage of low-wage labor, that's where the shortage was, the relative wage of low-wage workers will be rising. So we looked, bottom 20, bottom 40. It went up, but nothing to write home about, nothing that is consistent with 1 million vacancies. So we went to small businesses that employ 80% of those people, and they say, well, economists like yourself are telling us that a recession is coming. I'm not going to raise wages 5 minutes before a recession. And I say, you're not going to raise wages 5 minutes before a recession? You don't need this guy. It's very easy to say, I need 5 people. Press a button. Show me the money. And guess what? Those vacancies are dropping like a stone. And we are seeing the market normalizing in a big way. Let me illustrate by using this example. This is a very important illustration of the rate at which people move from one industry to another. Reached record high during COVID. Let me just illustrate using this example. Let's assume in a normal recession, not like this recession, a normal recession. You were an employee for Air Canada. You lost your job. You went on employment insurance for 6 months. After 6 months, the recession is over, you went back to Air Canada or any other airline. Today, after 3 years, you moved on. You went to totally different industry, totally different occupation. You moved on. So if you are Air Canada, you have to start fresh. You have to start hiring. And it seems that they were able to do it. We can see the line going down. But how do I know that? The other day, I took a flight from BC to Toronto, Air Canada. All the flight attendants, all of them were green, were new. How do I know that? They were extremely, extremely nice. Look at this chart. The orange dots before COVID, the gray dots during COVID. This is the relationship between vacancies and the unemployment rate. You can see how close the gray is getting to the orange. That's a normalizing market. The labor market is normalizing. Another example, the quits rate. One of the most powerful indicators in the labor market. People are not quitting anymore. The opposite is the case. You see the gap between wages for quitters versus stayers during COVID was a record high. So people were quitting. Now they're not quitting anymore. It's back to 2019. A major leading indicator of a slowing labor market. And all those strikes that we are seeing, they're all lagging indicators, not leading indicators. So this labor market is normalizing. So you are the Bank of Canada. You have to make a decision. What are you going to do? They are done. They are done, in my opinion. There is enough weakness in the market. The economy is basically in a recession. Inflation is moving in the right direction. I think they are done. They will still keep you guessing. They cannot tell you we are done, but I think they are done at 5%. The Fed is also done. We just got yesterday some good numbers from the CPI. You will need like crazy numbers for them to move in December. So both the Bank of Canada and the Fed are done. The question is, when are you cutting? When are you cutting? I say not before June of next year. You have to make sure that inflation is absolutely dead. And again, there are two ways to overshoot. One is you take interest rates way too high. The other is keep them high for longer than needed. They will do that. And the Fed will go after the Bank of Canada. Okay, so you stay until June, May, whatever, and you cut. By how much? We started this saga at 175, we're at 5, we go like that, and we go down. I say to 3. Notably higher than the 175 that we started. Why? Because we have some inflationary forces in the background unfolding. We used to have globalization. Now we have deglobalization. That's inflationary. We used to have just-in-time inventories. Now we have just-in-case inventories. That's inflationary. We used to have a labor market that was giving. Labor was cheap, no longer. That's inflationary. And let's face it, many of those green initiatives are inflationary. So major inflationary forces cooking. The target is the same, 2%. Same target, more inflation. By definition, interest rates have to be higher. 3% is a good number. Let me remind you that this economy, your businesses, and especially the housing market can do extremely well at 3% overnight rate. In fact, it's better. 175 and 0 interest rates were damaging the economy. It was good to have those beautiful mortgage rates, but it's not good for the economy as a whole. Cash was the most mispriced asset for many years. So after this episode, it will go down to 3% and it will be priced correctly and the economy can function better. I think that's a reasonable scenario. Now, why we need the Bank of Canada to cut interest rates? Because of this. This is if you renew now your mortgage. On average, 20% increase. If you renew now and you took the mortgage in 2020, the increase is 30%. That's now. My focus is on this. no less than 60% of all mortgages will be reset in 25 and 26, 5 years after COVID. 60% of all mortgages in Canada will be reset. If interest rates don't go down, we are going to have a major shock because the increase will be 50, 60% increase. But the Bank of Canada will cut. They will cut. Interest rates will still be higher than they used to be. They will not go back to where they were, and that's a good thing. There will be a shock. Some people will have to sell, distress sales, but this is not going to be a major shock. This is something that the market can take, and banks are getting ready for that. And people are getting ready for that. So that's the story. And the damage, of course, is in the housing market over the next 6 months. And the number one casualty will be the condo market. The number of investors that are in negative cash flow is now 54%. So we have a situation in which the majority of investors are in negative cash flow. Rent is rising, but not faster than interest payments. So we see a situation in which investors that are 50% of the condo market are not buying, and in fact they are selling. If you look at low rise is going down in terms of inventories, not yet in terms of condos. And I believe that will lead to slowing in the housing market over the next 3 to 6 months. Whatever we are seeing now is just an adjustment. It's just a pause. The fundamentals of this market are so strong, that within the next year or two, prices will be rising again. Unfortunately, because that will not fix the affordability crisis that we have. I had the opportunity to speak to the government when they were in PAC, in their retreat. And I told them, what we are seeing now, the slowing in the housing market, is not the solution for the affordability crisis that this country is facing. And if we don't fix it quickly, in terms of more supply, we are going to see anti-immigrant sentiments. We're going to see social unrest. We're going to see renter strike. It's on the wall, I can see it. So whatever slowing we are getting now, this is just a pause. This is not the real story. 6 months, we are going to see the market correcting, and that will be healthy. The condo market will lead. But over the next 5, 6 years, we are getting 1.2 million people into this country. We need to introduce a rental solution. And that's why we were pushing to remove the HST on purpose-built rental. They did it. We need much more incentives to developers to build purpose-built, because that's the future. That's the future. And that's the way we are going, the way we did it in the 60s and 70s. The housing market will take care of itself. And whatever numbers are coming, we are underestimating how many people are coming into this country. We are not measuring correctly. We are not counting them correctly. We have, in my opinion, 750,000 more foreign students than actually estimated in official numbers. For many reasons, I won't get into it now. But we have more demand for rental. Vacancy rate is 0. We need to build much more purpose-built, because the new wave of renters will be families with kids. They don't want to deal with the condo owners. They want to deal with the company. That's more or less where we are going. So to sum up, I suggest that we are basically already in a recession, especially when it comes to per capita recession. And if it's not a recession, it's very close to a recession. The Bank of Canada is overshooting by about 50 basis points, but that's fine. I think they will start cutting in the second half of 2024, and they will be cutting enough to get it to 3%, not more than that. That will ease the pain when it comes to resetting mortgages, but will not eliminate it. The recession that we are seeing now is actually a healthy recession. The recession that we are seeing in the housing market is the most significant test since 1991, but it's a healthy slowdown, because after COVID, when prices went up by 45%, you need a slowdown. And then, when inflation forces start dominate the space, namely deglobalization, just-in-case inventories and the rest, interest rates will remain at the new normal, which is 3% as opposed to 1.75. And your business and this real estate market can do extremely well in this environment. So I always ask myself, to what extent COVID was an event or a condition? Economically speaking, it's a condition, because clearly what was normal in the past is not normal in the context of today's economy. Okay? Thank you very much. Now, yeah.
Yeah, so we have about five to 10 minutes for questions. There, if you just want to raise your hands. I see one over here.
Yep.
Yeah.
Just
Price of an average car is over $60,000. Price of a car now is over $60,000. How can the average person buy a car? I mean, these electric cars are even more.
Absolutely.
And with the new wage increases across the board, with all these car companies giving their employees up to 25% increases, what's going to happen with cars in the future?
actually, I think that the prices will not be rising as quickly. Supply chain was a major issue impacting car prices. The latest numbers that we're seeing, actually, we're seeing slower inflation in prices. But I agree. When people say, and that's a problem, that inflation is down, it doesn't mean that prices will be going down. It's just the rate at which they're rising will be going down. So unfortunately, they will be staying relatively elevated for a while. I do believe that next year, car prices will be going down because of supply chain, but they will remain elevated, unfortunately.
You've expressed the opinion that 3% would be the inflation rate when you get to this trough. So what are 5-year Canada's going to be, and what are 5-year mortgage rates going to be at that point?
I think that we are talking about cutting by about 200 basis points. So take the current rate, cut it by 200 basis points. I think that's a reasonable scenario. And remember, the 5-year rate will be moving before the Bank of Canada's rate.
Hi. You want to talk about the dollar?
Yes, the dollar. Nobody knows. The dollar has its own mind. But we have to remember one thing. The number one factor impacting the value of the dollar is the rate of the spread between U.S. and Canadian interest rates. And this spread is very narrow. Very narrow because the Bank of Canada was overshooting and therefore raising interest rates way too much. I think this means that the Bank of Canada will have to cut more than the Fed. And therefore, I think that the narrative of the Canadian dollar improving anytime soon is premature. I think that the Canadian dollar will remain more or less where it is because the market is anticipating that, or even might go even lower than that.
Just to add to that question, can you talk about the inflationary pressures of the U.S. dollar losing its value to the Canadian dollar losing its value to the U.S. dollar?
Yeah, absolutely. Vis-a-vis import prices, when the dollar goes down, it's inflationary. However, the change lately in the dollar was minimal, so we're not talking about a significant inflationary force. So when you look at supply chain story and the disinflationary impact of supply chain improving, it's much more significant than what's happening with the dollar.
As a follow-up to that, the difference you mentioned having inflation. How much is the U.S. dollar ultimately tied to this whole picture?
The U.S. dollar has been relatively strong because of the fact that interest rates in the U.S. have been rising. The U.S. dollar will be losing strength over the next year the minute the Fed starts cutting, especially versus the euro, versus the yen, but not against the Canadian dollar in many ways because we will be moving with them. And that's the way I look at the situation. So a strong dollar is here to stay for a while until the Fed start cutting. Yeah.
Hi. Aside from interest rate policy, central banks have been expanding their balance sheets since the financial crisis. So we've seen in the form of QE. Now, interest rates, if they have peaked and if they go into cutting mode, what are your comments and insights in terms of shrinking balance sheets at central banks? Because that in effect has significant impact. So even if they stop raising interest rates and continue to shrink their balance sheets, that in effect is a tightening in the background as far as I could see.
Absolutely. That's exactly what they are doing. They are basically doing reverse quantitative easing. However, if you look at the impact of what they are doing now, it's equivalent to 20 basis points. So it's not a big story, but it's there absolutely in the background. Okay, thank you very much. Good luck.
Benjamin, thank you so much for being here. It's always so wonderful to have you out, and we really appreciate you taking the time. Our next speaker is Hemel Balsera. Hemel is the head of tax, retirement, estate planning at Manulife, and I'm glad to call him a great friend. He's going to cover the topic of life insurance and immediate financing arrangements. Hemel, take it away.
Good morning. It's great to be here today talking to everybody about one of the topics that I'm passionate about, which is really looking at leveraged life insurance and how that actually works from a macro lens. And there's a lot of tax benefits associated with it, but in addition to that, there's a lot of business reasons for looking into this. But with my presentation, what we're going to do is we're going to start off slow, start off with some basics associated with life insurance, and then we're going to build up in terms of actually getting into some immediate life insurance arrangements. So with that, in terms of life insurance policies, there's a variety of different policies that are available. There's term policies that cover off a specific period, for example, term 10, term 20, term 65, for example. There's whole life policies, and there's universal life policies. And with whole life and universal life, these are usually where we see the leveraging ultimately occur. And these days, it's effectively whole life, which is one of the areas that we're seeing in terms of policies being used. And with whole life, generally, there's participating, which participates in the par fund, and there's non-participating, which don't participate in a par fund. And as well, with life insurance policies overall, there's single life or joint last to die. So joint last to die being usually, typically it's done with spouses where effectively one spouse, or basically two spouses are on the policy, and effectively it's usually used as a means to time tax liabilities so that we can, on the second to die of two spouses, you can fund a terminal obligation. So in terms of life insurance policies that are personally owned, the death benefit ultimately gets received tax-free, and the premiums are generally non-deductible. And what you can also achieve is creditor protection. So if we have a preferred beneficiary election, so for example, we name a child, we name a spouse as beneficiary on the policy, we can ultimately usually achieve creditor protection on that and the cash values associated with that. With respect to the proceeds, they're ultimately paid to the beneficiary. They don't pass through the estate unless you name the estate as beneficiary, and effectively, by virtue of having that, we can bypass probate. In terms of corporately owned insurance, what ends up happening is we get the death benefit also tax-free, and premiums aren't deductible. And as well, generally speaking, in order to minimize any benefit issues associated with the policy, we want to have the same corporation be the owner, beneficiary, payer, associated with that. And what ends up happening is by virtue of that, you don't get creditor protection. So typically with like a overfunded like whole life policy, we typically want to have that up in a holding company we know we're never going to sell, just to minimize transfer implications, and also try to maximize creditor protection issues as well. In terms of the really where the rubber hits the road with corporate-owned insurances is we're able to use our tax-deferred dollars to fund the policy. So we get tax-deferred growth in the policy, we get the benefit tax-free, and in addition to that, what we do is we create a credit to our capital dividend account. And what happens when we have that is this is really the secret sauce associated with life insurance is the CDA creation. And what we're effectively able to do is turn taxable retained earnings into tax-free capital dividends. And the only catch is the insured has to pass away. So if we take a step backwards, I know, like you can't have it all, right? So, but really my point is when we have leveraged insurance, what happens here is we effectively get a CDA credit for the gross death benefit. So just walking through a simple numerical example, let's just say we had a $5 million death benefit and a $4 million loan. The corporation only gets $1 million of cash after the loan is repaid. However, where that same corporation is the beneficiary, what happens is we end up receiving a CDA credit for $5 million. So effectively, we've created $4 million of residual CDA. And that residual CDA, for the tax practitioners in the room, can be used to strip out other assets from the corporation or be combined with the postmortem planning strategies that you deploy to ultimately help reduce the effective tax rate at the time of death. So that's really one of the big reasons why corporate-owned leverage insurance has been, so powerful recently. So in terms of accessing cash values, what are the ways that we can actually access cash values? One way, contractually obligated within many policies, is to get a policy loan. But the thing with policy loans is you effectively can draw them down to effectively the ACB, and then after, it's 100% taxable income inclusion, because policy gains are fully taxable, and if you have them in a corporation, they're going to be treated as investment income. In addition to that, another way of accessing cash in a policy is to effectively take cash dividends. So effectively, what happens is we end up receiving a dividend on the policy, so a lot of participating whole life policies pay dividends, non-participating whole life also pays dividends, and what happens is we can draw down up to the ACB of the policy, and again, after that it's 100% taxable. Withdrawals, from day one, when you withdraw money from a policy, you're going to get a proportionate income inclusion associated with that, assuming that your cash surrender value is higher than your ACB. And this is where the last option is really where we're going to be focusing our presentation on for the rest of the session is collateral loans. These are received tax-free. So effectively, a policy gets collaterally assigned to a bank. What happens is we are able to access the money within the policy tax-free via that collateral assignment. So this is an important step. So a lot of times when you hear leveraged life insurance, immediate finance arrangements, this is what they're talking about, is really the collateral assignment of a life insurance policy. So in terms of leveraging options, there's a couple of different ways to do it, but it's really more of a timing issue more than anything else. The first way of doing it is we often see it in the deferred leveraging context, where you give somebody life insurance protection today, and then in the future, they'll access the money in the policy through a collateral assignment and effectively try to create a retirement income stream for themselves. So in the Manulife world, we call these strategies the insured retirement program if you do this individually, or alternatively, if you do it through a corporation, it's the corporate insured retirement program. But really, the gist of it is we're using a corporately held policy, getting tax shelter growth in the policy, and then ultimately assigning it to create a loan, and ultimately using that loan to create retirement income for ourselves. In terms of the other side of the equation, it's the immediate leveraging. And this is where we commonly refer to it as the immediate finance arrangement. And this is where we're using effectively the borrowing, so putting money into a policy, we're borrowing the money back, and we're ultimately leveraging that to invest. And this is the key, to invest. And with IFAs, in terms of like how people have deployed them, I was able to get some statistics for the group from our sister company, Manulife Bank, and what we were able to identify is there's 882 unique IFAs on the books right now. About 516 are corporate, 366 are personal. And I found that actually surprising because of the CDA benefits associated with this. Like, I would have thought there would have been definitely a higher proportion of corporate deals on the books. The other piece of the puzzle here is the average IFA loan account's about $2 million. So effectively what that means is you're putting in $200,000 a year into a policy for 10 years, for example. And on the corporate side, that's $2.3 million. On the personal side, it's a little bit smaller at 1.6. About 88% of these deals are whole life. So this is what I found also interesting, because 88% are whole life, only 12% are universal life. But the reality is the bulk of any new businesses being placed these days in the industry, it's definitely on the whole life side associated with this. And the average age is about 52 years, and the largest cases have been like 52 million, 50, 45, and 41. So that basically means when you see that full number, you divide by 10 to come up with the average for the 10 years. So how does an IFA work now that you've got a macro context associated with this? Effectively, the client buys a permanent life insurance policy with cash value. And effectively what happens is that policy is assigned to the bank, and the client pays the recurring insurance premiums. What we're doing, however, with this is effectively the client will borrow back up to 100% of the cash surrender value. So effectively, many banks let you leverage and margin the accounts up to 100% of the cash value. But if you want to borrow back even more, so let's just say, for example, you want to borrow back the full amount of the premium, cash values aren't going to equate to the premium amount, so effectively you have to pledge additional collateral security. And what happens is we then turn around, once we get the borrowed funds, and use that to invest. And effectively, these steps are repeated annually. And the key to any IFA is effectively, leveraging, if your rate is 7% on the loan, you want to invest at a higher rate than 7% because effectively that's really, leveraged investing 101 in terms of any of this to actually make fiscal sense to actually do this strategy. So then when the client ultimately passes away, what happens is the life insurance goes in two different directions. Because the policy was collaterally signed, it goes to the bank, and then the residual death benefit goes to the beneficiaries. And if we do this in the corporate setting, as we alluded to earlier, we effectively are able to create residual CDA for the difference between for effectively the loan amount of the policy. So effectively, this can be a great way to distribute trapped surplus from the corporation. And with the IFA, there's typically three structures that are being deployed. We borrow up to the cash surrender value. That represents about 25% of all of the IFA deals happening these days. We can borrow up to the premiums paid. We're looking at about 70% of all deals, and then the remaining is borrowing the premiums plus the interest. There is some alternative planning given the fact that interest rates are so high, and that's really delaying the borrowing for a couple of years. So effectively funding a couple of years and then turning around and having the ability to turn around and invest associated with this. And ultimately, when you borrow in excess of the cash surrender value of the policy, you're going to have to pledge additional collateral security. And that could be in anything from the form of like a letter of credit from another financial institution all the way up to investments and so on. Why does somebody even do an IFA? Well, it lets them have their cake and eat it too, in the sense of they could basically turn around, have the policy, guarantee their insurability, and then turn around and use that money to invest. The cash values ultimately grow tax deferred. So this is really one of the other big benefits. You're not, if in the corporate setting, you're not subject to investment income tax rates on this. Effectively, the cash values grow. What we also achieve is the ability to create some deductions. So assuming that we're using the borrowed funds for an income generating purpose, what happens is effectively some of the interest will be deductible and some of the premium through the collateral insurance deduction. You're not going to get 100% write off of the premium. You'll get a small portion of the premium through the collateral insurance deduction. And ultimately, the borrowed funds are received tax-free. And if we do this corporately, what happens is we get a CDA credit. And that really, this is one of the big reasons why this is being done, is to create that residual CDA. So there's an enormous benefit to doing the IFA in the right situation. There are some questions that come up. If we did this in a corporation, and if we did the IFA in a corporation, but instead we took the borrowed funds at the shareholder level, are there, could this be a potential solution? And I'm personally not a fan of this. There's a series of different tax issues associated with this. There's shareholder benefits during your lifetime and at death, and effectively what happens is these shareholder benefits issues put you in a place where it can significantly wipe out some of the benefits associated with this, and there's a series of other issues. The biggest ones are the residual CDA that we talked about. You're not going to get because it gets consumed as part of the loan repayment process, and you get extra capital gains exposure potentially at death where you have common shares. But really, I wanted to spend some time. I got the 2-minute warning from Ali, but effectively, I think the trap door is going to take me down to the crocodiles after this. But no, I'm kidding. But really, where is the IFA good? And there's two different scenarios on the opposite sides, but basically the middle is where we really want to do it. We want to keep it corporate or keep it personal. We want somebody who's affluent with sufficient cash flow and comfy with the ability to leverage and wants to leverage, and they require permanent life insurance, and they require, and they're at a high tax rate. Because what happens is with the IFA, the internal rate of return of this concept increases when you have a high tax rate. So you want somebody with a sustained high tax rate doing this. And ultimately, CDA creation, postmortem planning is important to this client, and they're sophisticated. Where we're seeing it, where we're seeing problems with the strategy is inappropriate, where effectively we've got premium financing occurring, where effectively people are being told, look, you just, put the money into the policy and then you basically get the money back out and Manulife will pay the premiums after that. So it's one of those things where this whole idea of premium financing is problematic, and I think this is one of the areas where it's been marketed to clients who may not have the sophistication, and we're coming across problems in this space. The other place where we're seeing is where it's combined with like aggressive surplus strip planning, where we're doing circular transactions, where we're doing aggressive split dollar or life insurance shares involving premium financing. All of that stuff is super aggressive, and it's really not about the estate planning. And effectively, this is where I think in the long run, some of these more aggressive plans are going to be negatively impacted by GAR. So really, it's the cream filling of the Oreo that's important. The cookie part is really, problematic in terms of this sense. So there's, from a macro perspective as well, there's some headwinds happening, as Benjamin just talked about. There's interest rate issues. I mean, the lower the interest rate, the better for this concept, because it makes it generally better. As well, if we do this on the personal side, AMT, alternative minimum tax, is going to be an issue because effectively now you have interest deductions, and now there's a 50% add back, and then we have to consider the EIFEL rules if we do this in the corporation on the corporate side. So with that, I'm going to open it up to questions. I went through that fairly quickly. I'm just looking at the picture, the video right now. I feel like I had too much Diwali sweets. I'm like, I look like I've got like a couple extra chins on me. So, but yeah, I just want to see if there's any questions in the room.
Hamel, I'm going to ask a question.
Yeah, absolutely.
And you and I have done quite a bit of speaking on this topic as well.
Absolutely.
So question for you. So I loved your Oreo concept and the filling in the middle. Another way that I would put it is I would talk about its applicability for people who live beyond their means. Do you think that this is something appropriate for somebody who spends more money than they have and sees this as a quick fix?
Yeah, I think that's not sustainable in the long run, because really, at the end of the day, this is a concept where we're using this to ultimately use to invest, because we're able to achieve deductions along the way. We're able to ultimately use this as a means to create some estate planning needs within the corporation or the individual side, where you're using this just as a means to like be your own banker, or like, just provide some funding, especially, or alternatively using this as a way to strip money out of a corporation to ultimately use to fund lifestyle. I think that's where we're going to have problems, especially on the immediate side, because that's where you lose out on the deductions. But in addition to that, it also becomes one of those issues where somebody with lifestyle issues is probably going to, they have trouble managing their funds anyway, and this could just lead to another pile of debt that could create more problems for them in the future, and ultimately something that's not sustainable for the client long term.
Hi, Emma. It's Warren. We know each other, full disclosure. Just your thoughts, maybe from your world, from Kalu Step. What do you think the future of the CDA looks like in our world, or capital gains inclusion? What are your spider senses telling you about that?
Yeah, that's a great question. So, a few questions have come up recently around CDA. It always comes up, but CDA is a fundamental integration mechanism, right? So if we take a step backwards, the capital dividend account is a fundamental integration mechanism. So I do think that the future is bright. However, if we look at 89(1)(d) of the Income Tax Act, which is the provision that governs, that has the rules around CDA, and particularly life insurance as well, what happens is that provision has been whittled away over the years in terms of, like, it just previously was death benefit minus the ACB of the life insurance contract. Now you've got adjustments for transfers that happened between 1999 and 2016. Now you have adjustments for 10/8 and leverage insured annuities. And one of my concerns is from a macro perspective is could aggressive plans, be another addition to the exclusion list? So that's one place where my mind goes. The other piece of the puzzle is we get the question of would capital dividends be subject to AMT, right? In the future. And I don't think that would be an issue, because, like, when they went through the exercise of ultimately determining, what would be included in AMT and what would not, they had the chance to include it there. So I do think at the end of the day, CDA is still in a good place, but we just got to be careful with some of the more aggressive plans. So thank you.
Hemel, just because of the crowd in the room, can you talk about whether you've seen this used with charitable life insurance policies and whether you think that's the right fit for that type of client?
Yeah, that's a great question. I mean, I prefer to keep, like, if you're going to do leveraging, just do it in the corporation or do it in the individual side. Don't necessarily do it trying to combine it with charitable, because what you run into when you have it with the charitable side of things is there's benefit provisions, right, that can apply, so that could potentially reduce the amount of the gift. The other thing too is like, you know, CRA, you know, had a recent technical interpretation that effectively, you know, said, you know, it could restrict the amount of charitable, donation that you could receive. Like, it basically alluded to the fact that there might not be the ability to claim a charitable donation where there's shared ownership of the policy. So I prefer to keep things separate, just because you avoid the benefit issues. And the other thing associated with that, the benefit issues and the advantage issues, but the other piece associated with this as well is often, you know, where it's done in the charitable context, it's done with, like, you know, smoke and mirrors, right? Like, in terms of the intent to, you know, really not leave the charity with much, but you know, take advantage of the fact that you get donations. So my short answer is not a fan of these. Like, you know, there may be a case by case where it may be different, but generally speaking, just keep it simple, keep it separate, right? Perfect. Thank you for your time. Thank you for your attention.
Thank you so much, Hamel. All right, Jamie, where is he? Come on up. Okay, so Jamie and I are now going to be speaking about AMT and charitable giving. Jamie is a managing director of tax and estate planning at CIBC Private Wealth, and I am a partner in the tax and estate planning group at Crowe Soberman LLP. Take it away, Jamie.
All right, we're going to set our timer because we have so much to talk about and not enough time, as always. So let's talk AMT. Let's get the slides up here. That is not my slide. Thank God I don't have to speak about this. All right. So very quickly, what is AMT? So let's start in general before even talking about that of why we're even here, why we're even talking about it. AMT is a 1% problem. So to illustrate this very, very quickly, if you look at the number of people that file tax returns in Canada, there are 30 million individuals that file tax returns. 2/3 of those people make under $50,000 a year. And what's interesting, of course, is if you look at the donors, there's a disproportionate percentage of people that make donations to charity. But for me, what's most interesting is the dollars donated. So if you go back to the tax return data and you see the number of donations from personal individuals of either cash or securities, not donating books and times and clothing, but, you know, actual stuff reported on returns, of the $1.6 million of income, and you can sort of see the income dispersion, when you look at the actual dollars donated, you can see that 41% of all the charitable giving in Canada on the personal side, so of the $11 billion given to charity, 41% of it is coming from the 1%. So the next 8 minutes is about the 1%. So that is really what we're focusing on at AMT. AMT will not affect the 99% of clients. It will affect the 1%, and that's why we want to talk to you about it today. So we've written lots of material. There's lots of supporting material online that Alex Ferb has written, we've written at CIBC. That's all available, easy to find. So bottom line, AMT has been around since 1986. The rate is 15%. The budget is, basically saying that even though we have AMT, it's not enough because the wealthy aren't paying enough tax. And they are concerned that, in fact, people are getting away with very low effective tax rates. So what they're going to do is they're going to broaden the tax base. So right now, as you know, capital gains are 50% taxable. Employee stock options, other than the recent amendments a few years ago, are 50% includable. And when you donate publicly traded securities, mutual funds to charity, there's zero inclusion rate. Under the current AMT system, the 80% inclusion rate applies when you recalculate your income for AMT, for capital gains, and for stock options, and you still have 0% for capital gains. Starting next year, Jan 1st, 2024, 100% of capital gains are taxable, 100% of employee stock options are includable, and 30% of the gains on donations of appreciated securities and mutual funds, seg funds to charity will be taxable. So that is going to be a potential impact in some scenarios for donors in that 1% that are donating to charity. The other problem, of course, is they're only going to allow 50% of non-refundable credits. Now, most non-refundable credits aren't worth anything, like the basic personal amount, medical expenses, no matter how much they are, they're worth 20%, 25%, not very much. The donation credit is the exception, because anyone making over $200 a year of donations is getting between 40% and 50% back in Ontario, depending on their level of income.
The other thing that we have to keep in mind is that, again, this is a 1% problem because there is an exemption, which is currently $40,000, that's going up to $173,000. So bottom line is if you make under $173,000, you're just not going to pay AMT next year. So that goes away with about 98% of our clients. And then what they're doing is they're raising the rate from 15 to 20.5. So simple example, the federal rate right now, the top federal rate is 33%. So on capital gains, it's 50% taxable, so half of 33 is 16.5. When you include capital gains at 100% on January 1st next year for AMT, you're effectively raising the capital gains rate on the federal side, right? And you're raising it to 20.5 from 16.5. And that's just federally. And then you add Ontario on top of that, you add another 2.5%. You're getting basically a 7% increase in the top rate on capital gains. So that's kind of the effect and where we see some of the clients fitting into it. So ultimately, the government expects to collect $3 billion over the next 5 years in AMT. 99% of it will be from people making over $300,000 a year. So that's kind of the number we're using with our clients, is that if you make under $300,000 a year, you probably don't have an AMT problem. And most of it will actually be paid by people making over $1 million a year, so 80% of it. Ali, a few other issues that you've spotted in your practice.
Thank you so much, Damien. I'm not quite as tall, so I'm going to have to kind of stand to the side here. Okay, so we're all advisors here. We want to cut to the chase and talk about, in your practices, who should you be thinking about as who is going to be most affected by the AMT changes in 2024 and forward. So, and the first thing I want to say as well here is we are not here to tell you or for you to tell your clients that they should stop making donations. That's not the reason why we're here. They should absolutely continue to make donations, and in fact, making donations through the donation of public company stock is still very tax efficient. It's not quite as tax efficient as it maybe would have been in 2023, but it is still very tax efficient. So that's important. One other thing quickly just want to say too is that remember AMT applies to individuals, certain trusts. It does not apply to corporations. Maybe we'll be here next year telling you, guess what? The government figured out the big change and made it apply to corporations, but it doesn't apply to corporations. It also does not apply in the year of death, which is extremely important. That's when many people have a huge realization activity. There's no AMT in the year of death. So we've highlighted some points here of clients you should be looking out for in your practices. Number one, clients with very large deductions on their personal tax returns. Interest expenses, carrying charges, which include wealth management fees, other professional advisory fees. I have certain clients, for example, where we have clients with, I would call it almost a wash scenario, huge amounts of interest expense going out, but an offsetting huge amount of interest income coming in. Depending on their circumstances, because that interest expense is only 50% deductible for purposes of AMT, if they have other sources of income that are preferential, they can end up with some massive, massive amounts of AMT, which can be problematic. So look out in your client bases for clients who have very large deductions on personal tax returns. One thing that's really strange, which is probably a drafting error, although we haven't seen it fixed yet, is the claiming of losses between years. Right now, if an operating loss on an individual's return, and many people do end up with these things from time to time, if that loss is carried forward and used in a subsequent year, or if it's carried back to one of the prior 3 years, there's a very strange result that only 50% of the loss is allowable for AMT purposes, which makes no sense, right? If you make money in year one, you lose money in the next, they should offset and cancel. For some reason in the world of AMT, it doesn't. This is very important. Employees who exercise large amounts of stock options. So if you have clients who are senior executives in public companies, banks, other financial institutions, that's who I generally see with very, very large gains in stock options. Keep in mind that, remember, the stock option benefits are not taxed as capital gains, they're taxed like capital gains. So, I had one client, he tells me he has a $10 million embedded gain in his option position. And he said to me also, oh, but guess what? They're fully vested and they expire in 2024. I'm going to exercise next year. And we said, wait a minute. If you exercise next year, that's an additional $700,000 of tax because of the AMT. So we did the analysis to determine if he should exercise in 2023 or 2024 based on all of the factors. That's why we're here. We're still in 2023. You got to be thinking about these people and seeing if they should take action in 2023. Also, employees who exercise and donate large amounts of public company stock options. Some of you may know that if you exercise and donate public company stock options within 30 days of the exercise, you can end up with that option benefit being taxed at zero in the old rules up to the end of 2023. Going ahead to 2024 won't be the same, it won't be as advantageous. It still probably will be the most advantageous way for a person to make a gift. It just won't be as amazing. That's the way that I'm describing it. It won't be as amazing. Something that we're going to have to think about, which this one might creep into more than just the 1%, but prescribed rate loan trusts. So, I'm sure many of us have clients where it's a wealthy family. A parent often would make a loan back when the prescribed rate was at 1%. We don't see many of them being made now. I think the prescribed rate's going up to 6%. But when you had that loan being made to the trust, the issue in 2024 and forward is that all of the carrying charges, interest expenses, wealth management fees in that prescribed rate loan trust will only be 50% deductible for purposes of AMT. And traditionally, you wouldn't have income in these trusts. The whole point of the trust was to have investment income earned in the trust, 1% back paid to the parent for purposes of the loan, and all of the rest of the investment income allocated to usually minor children for purposes of income splitting. We're now going to have, it's true, maybe it's only, $5,000, $6,000. There's going to be an amount of tax that has to be paid. In the grand scheme, the dollars might not be material, but I think we're going to have a lot of pissed off clients. So we have to warn them, we have to talk to them about it. I won't get into it, but spousal testamentary trusts, there's also a strange result in spousal testamentary trusts. One comment I want to make here with respect to American citizens. With many clients, we are talking about incorporating investment portfolios. It's the last point on here as well, where if you have investments with, whether it's shares of private companies or if you have an investment portfolio with a large embedded gain, perhaps the planning in 2023, before a new GAR comes into play in 2024, is to transfer those investments or shares of private corporations into a holding company to have the eventual gain happen at the holdco level. As I mentioned, AMT doesn't kick in at the company level yet. Hopefully it never does. That planning, depending on the type of corporation used for an American citizen, may or may not be possible. So that's just something to put out there, that ultimately what this means is some people will end up paying higher tax. Maybe they can use up AMT if it's paid in a future year, maybe not. Some people are just going to get stuck paying higher tax. I will say that if the government's intention, I believe it was to raise taxes, they probably went about it in the most convoluted, complicated, difficult way to understand possible. Here we are. Last thing I just want to say, departure tax. I can't see this timer. Departure tax. If you have clients who are leaving the country, we know that in Canada we pay tax on gains at the earlier of 3 times. When we pass away and leave assets to another generation, when we sell the asset, or when we leave the country. The challenge with departure tax is that you will have AMT if you're subject to AMT, but you have no ability to get it back. You have no ability to claim the credit in one of the following 7 years on any AMT paid on departure tax. Very quickly, I'm just going to say, what can advisors do? We talked about consider incorporating investment portfolios in 2023. It can help with a variety of different things. It's not all sunshine and roses with corporations. You have to watch out. There's a little bit of an under-integration, I would say, on investment income with corporations, but it might help. Proceed carefully once in 2024 in the world of new GAR. Something important here is you have to talk to your clients, each one of us, about their philanthropic goals and objectives so that you can help them achieve those goals and objectives in the most tax-efficient manner. Yes, I always have a tax lens on, and we want to be as tax-efficient as possible. We have to have those conversations with clients. And the last point here before I turn back to Jamie is that we're still in 2023. There is time to take action if you need to with clients. Speak to them so that they know that the status quo that we've had up until 2023 is not going to be the same in 2024.
Let me just spend the last minute or so, because we're pretty much out of time, just sort of to wrap up on what the issue is on the charitable side, just so to take this message away with you. So we wrote a report specifically on charitable giving at AMT that's available online. The bottom line is clients who have over $173,000 of income, you should do a pro forma calculation for next year, particularly if they've got weird stuff like capital gains, employee stock options, Canadian dividends, losses carry forward. Donations will further exacerbate the problem. Donations alone will never cause AMT. AMT. That's something we've tested mathematically. But if someone has large capital gains, dividends, any of these things, donations could cause an additional problem because they could create more AMT because of the 30% inclusion rate on donations of appreciated securities and the 50% limitation on non-refundable credits. So just a quick, very quick example. Someone with high income who makes $100,000 of donations will not have AMT. Like, high income doesn't mean AMT. This is just regular, ordinary business income, self-employment income. You're not going to have AMT no matter how big your donation is. You start getting into dividend income, and all of a sudden you've got some dividends, you're making cash donations, then you do have AMT. So again, without worrying about the math here, just conceptually, if someone has weird types of income other than employment income, self-employment income, business income, then they could actually have AMT. It gets even worse, though, where you have someone who's not a high-income earner that just sells their cottage. And the only thing they did next year is sell a cottage, and all of a sudden you've got AMT. A donation in the year of sale is usually a common strategy that we often recommend. Well, next year that's going to cause a big problem, because if next year we make a donation in addition with a sale of a cottage, all of a sudden our AMT will double to $40,000. So again, these are the high-level issues. We just want to remind you that now is the time, as advisors, to reach out to your clients. You don't want them to be surprised. Maybe they could consider making the donations this year instead of next year. And of course, we are here, of course, at the Donor Advised Fund here at the UJA Jewish Foundation. A Donor Advised Fund, I think, is the perfect solution to pre-fund those donations in 2023. You have no impact whatsoever on AMT, no impact on donation appreciated securities, and no limitation on the 50% donation. Any final comment?
I was just going to say one caveat. It's true if you can fund a donor advised fund in 2023, just make sure you can use up the full amount of the donation receipt in 2023. You don't want to have to use that donation receipt in 2024, because then you can get stuck into the world of AMT. So with that, any questions? Yeah, absolutely. So the question was, is if you don't have the trust but you have a spousal loan, that interest payment made by the spouse who made the loan, the spouse who received the loan and then presumably is receiving very tax-efficient types of income, dividends, capital gains, that person may absolutely have a problem if their investment income or their total income is high enough. So all deductions, including interest expense, regardless from if it's a third-party financing or from a spousal loan, is only 50% deductible for AMT purposes to an individual. Yeah. Ron.
Hi. Just one quick comment, not a question, and that is the legislation has not yet been passed. The advice that we're giving to our clients is to run your AMT sensitivity for next year, show what you would have done next year and the impact AMT changes will have. Go talk to your member of parliament. I know that there are a number of charitable organizations that are now actually weaponizing this and saying that with respect to those ridings where there were, where there's swing ridings, that people in the philanthropic community are more trusted than politicians, and that they're now talking loudly to your local members of parliament to say this is inappropriate, this is just bad. Taxing the rich while giving away money is a disincentive to assist in charities. And that's my only comment. Thank you.
100%. Thanks. Any other questions?
One more.
Yeah.
Yeah, this may be a tough one, but including Ontario, what would the maximum marginal tax rate on dividends be? Canadian public corporation dividends go to, including AMT? It's 39 point...
Yeah, it's about 40% on the dividend without AMT. I don't know that I can think of it including AMT. I've never thought about it that way.
Well, no, it wouldn't be high. Like dividends alone are not going to be an AMT, because for AMT purposes, there's no gross up and no dividend credit.
Right.
So just basically apply an AMT rate of 20.5 to a cash dividend, right? And then you have the provincial amount. So AMT will not apply to dividends alone.
Okay, thank you.
I guess it's the final point I'm just going to say is that the more preferential the makeup of your personal income is, when I say preferential, capital gains, dividends, because you're not paying 53% tax like you would on a salary or self-employment income or a bonus. So the more preferential your income is, the more deductions you have, the more likely AMT is going to hit. Okay? Thank you. Thanks so much, Jamie. Our next speaker is Emily Ben-Hayam. She's a senior investment counselor at RBC PH&N Investment Counsel. Her topic is financial planning, specifically related to FHSAs, and prioritizing the rest of the alphabet soup. Thanks, Emily.
Good morning, everyone. Thank you for your time. Great to be here today. Just before I get started, on a personal note, as an Israeli, I wanted to sincerely thank the UJA and all its supporters. The work that you've done for Israel and the community and continue to do is truly incredible, and it's very heartwarming, and I'm very grateful to you and proud. So thank you very much for that. I'm here today to speak about the First Home Savings Account and how it works together with the other registered saving account types. And I hope this is valuable not only to yourselves and your families, but something that you can help advise your clients on as well. It's a bit of a mouthful to say the full name, so I will occasionally address it as the plan or FHSA. During the next 10 minutes, we're going to be walking through what is the First Home Savings Account, how it works, making the most of it, some other tips, the eligibility requirements, and how to prioritize the contributions to the various registered plans. This is the newest registered plan introduced. It was introduced this year by the Canadian government, and it's designed to give prospective home buyers the opportunity to save on a tax-free basis towards the purchase of a first home in Canada. The annual contribution amount is $8,000 up to a $40,000 lifetime contribution. How it works. It really combines the benefits of an RSP and a TFSA. It's like an RSP in that any money going in is tax deductible. The amount that's put into the plan can be invested like you would with an RSP and TFSA, and the growth that you make while it's in the plan is not taxable. When you take the money out of the plan, similar to a TFSA, you are not paying any tax on the withdrawals, so long as you're taking it out for the purposes of buying a home within the first 15 years. Some things to consider to make the most out of the plan. You shouldn't necessarily wait to open one. The contribution room starts to accumulate the moment you open the plan, even if you don't contribute to it immediately. So even if you can't make a contribution in a specific year, you can still carry forward any unused contribution room for future years up to a maximum of $8,000 per year for a total maximum annual contribution of $16,000. Let's talk about the tax benefits. Like an RSP, contributions don't have to be claimed, the deductions don't have to be claimed in the year you make the contribution. You can carry them forward indefinitely and deduct them in a later tax year where perhaps you're in a higher tax bracket. And if you don't have the cash available to contribute this year necessarily, you're allowed to take money out of your RSP and put it towards this plan. You can also use the plan to help your family members. If you already own a home, you can still gift money to your children or grandchildren, money that otherwise in your hands might be subject to a higher tax rate. The FHSA can also work together in conjunction with the home buyer's plan, which means that you can take the home buyer's plan, you can take $35,000 out of your RSP for the purposes of buying or building a home. So if you combine both of these together, you're looking at a total of $75,000 in capital, plus any growth that you would have made while investing in these plans. Some other tips. If you didn't buy a home, don't worry. The plans do need to be closed after 15 years, or at the latest, the year where you turn 71 by the end of that year. But any money that you didn't use within this plan, you can put back into your RSP or RIF, so you actually never really lose it. And please don't forget to designate a successor, so a spouse or a common law into the plan, similar to an RSP and TFSA. If something should, God forbid, happen to you, the plan can roll tax-free to a spouse or common law. Otherwise, if you don't designate a successor that way, it is subject to tax on your passing. Now that we know more about the plan, let's talk about who's eligible. A Canadian resident, over the age of majority and not older than 71 on December 31st of the year the account is opened, and a first-time home buyer. It's very important to understand the definition of a first-time home buyer for this purpose. It's defined as not owning a home lived in as a principal residence at any time during the calendar year or the preceding 4 years of opening the plan. What this means is, and the same has to apply for your common law or spouse if they're living with you. But what this means is that under this definition, even if you had purchased a home in the past, you might still be eligible to open this plan. This reflects how the different accounts can work together. You'll notice that the FHSA does definitely tick all the boxes and hit all the criteria, but you can definitely use all three of these plans in conjunction together. Please note and excuse the typo. The home buyer's plan is $35,000, not $30,000. What if you're unsure on how to prioritize all these different registered plans? I would suggest starting with the free money. If yourself or a family member has a disability, consider opening a registered disability savings plan. You can gain up to $90,000 in grants. If you have children, definitely consider the registered education savings plan, where you can receive from the government up to $7,200 per child. And lastly, the first home savings account is effectively a free option, because anything going in is receiving a tax deduction, so there's no tax on the way in, there's no tax on the way out, and if there's anything left over that you're not using, you can move it to your RSP. After that, consider your short, medium, and long-term saving goals. For short-term or medium goals, such as a house renovation or an upcoming wedding, I would consider your TFSA. It's flexible. You can take money out and you can put it back in. You don't lose your contribution room. For anything which is longer term, such as retirement savings, I would consider your RSP, especially if you are in a higher tax bracket now than you think you're going to be when you retire. To recap, this new plan is flexible, it's tax-free, and it's effectively used with the other non-registered, the other registered savings plan like your RSP and TFSA and so forth. So thank you for your time, and I welcome the opportunity to address any questions you might have. No questions? You're welcome. Thank you.
Thank you so much, Emily. I was just thinking that maybe, if your kids, receive bar mitzvah money for their bar mitzvah, might be a good use of putting it into an FHSA when the time comes, if you're not going to otherwise use a donor-advised fund for it. So thank you so much. Our next speaker is going to be Jonathan Liebtag, who is Senior Counsel at Microsoft. He is going to cover the highly discussed topic of generative AI and its impact on work. Jonathan, come on up.
And go. Oh, there you go. All right, thank you for having me today, and it's really a pleasure to join this group. My presentation today is certainly topical. There's been a lot in the media and the news about AI, but I really do hope that on top of hopefully being interesting, there are some practical tips for folks in this room in terms of how they can leverage technology and specifically AI in the work that they do. I'm having trouble with the clicker here. Wrong button, that's probably. There it is. All right, I apologize. So when it comes to technology, AI has certainly been the story of the year, and it's going to be the story for years to come. But 2023 really represented an inflection point for AI, because this year we saw powerful new applications like ChatGPT, Bing Chat, and you're going to hear a lot about Microsoft Copilot if you haven't already heard of it. And these powerful applications have been used increasingly throughout society. And these breakthroughs have been driven by something called generative AI, developments in generative AI, and I think it's really important to drill down on exactly what that means so we can really dig into the significance here. Generative AI is a subset of artificial intelligence that's capable of creating new content, such as images, sound, and video. And traditional AI, and there's so many subcategories, but for the sake of simplicity, really focuses on performing specific tasks intelligently. So these systems are capable of learning from data, vast amounts of data, and making decisions or predictions based on that data. And it's absolutely amazing. So when you turn on your Netflix or your Amazon Prime, all those recommendations you get are a function of AI. When you, interact with Alexa, that is traditional AI at work. But it's this notion of AI creating or generating content that is net new is what's truly amazing. So let's look at an example. There's a lot of parents in this room, and I see there are a lot of likely grandparents in this room, and I have a 4-year-old son, and he loves stories. He can't get enough stories. We've read every book in the house. He wants to hear a story not just at bedtime, but when we play in the morning, and I'm out of stories. But now what I can do is I can go to ChatGPT, and I can ask it to write me a story. My son loves dragons. He's 4 years old. He loves his cousins Kenzie and Mason, and he'd love to hear a story about it. Well, now I'm a master storyteller. Just like that, based on a simple prompt, I have net new novel content based on my instruction. It's truly remarkable. Now I can make this story longer, shorter, I can make it more funny, I can make it more sad, I can introduce new characters, all with a simple prompt. Now, this is a pretty cute example, but it's just scratching the surface in terms of really its utility. So let's move across the spectrum in terms of, well, how can this help me in my day-to-day work life? My friend Jonathan Greenwald, who's here today, and is my financial advisor, and he sits on the committee that organizes this great presentation, it's a great morning and event, and he writes a great newsletter. And I want to support my friend Jonathan, and I think it's good content. But despite how crisp I think Jonathan is in his writing, sometimes, frankly, I just don't have the time to go through the article. So I can actually pull the article in my browser and leverage an AI tool, and I can ask it to summarize the article for me. And it's truly amazing. Now, this is a short article, but I can do the same thing with a multi-100-page medical journal, an academic journal, financial statements, market research reports, and I can get there it is, as I was thinking, I can get a summary of it, and I can continue to iterate on the summary to get the information I wanted. And if Jonathan's reading this, I think this will accurately summarize the article that he wrote. But as we think about the way we work, maybe Jonathan, and he's a financial advisor to not just me, but I imagine dozens, if not hundreds of clients, can think about how can he spend his time more effectively? How can he optimize his time? And the article that I just showed on the screen was a great article, but I imagine it took Jonathan every bit of 10 hours, maybe 12 hours to write from beginning to final draft. Well, Jonathan can go to Microsoft Copilot, and he can ask it to write an article for him. So the article that he wrote was about maybe the media isn't the best source of financial information, and you'd be smart or it'd be advisable to seek the expertise of a financial advisor. And as it thinks about it, it will create an article from scratch. And what's important to think about and important to note is this is data that's being pulled from the public web. But what we're starting to see, and a lot of organizations that you work for, are going to be adopting this technology to leverage its enterprise data. So think about RBC. If it wants to leverage this technology across its proprietary databases and pull insights to generate content, they can do that. So think about how much time this can save analysts, for example, and think about the access to the mind share now that anybody in a company has based on the development of good work and learnings over the course of decades that's been buried in databases deep within the company. Now, there's a lot of excitement when we hear about this. There's a lot of doom and gloom as well, I'm sure, as you've seen in many articles. But this is actually a very natural response with transformative new technologies throughout history. And we can go back to the printing press. If you go back, I think that's the 16th century. It's one of the most transformative technologies in human history. At that time, it was met with only fear that it would create laziness. And back in the 16th century, they were thinking about jobs too. They thought that the printing press would displace the thousands of jobs for the important individuals known as scribes. Back in 1825, when the Stockton-Darlington Railway opened that year, people insisted, again, trains, probably the most transformative modes of transportation we've seen in human history. But when it came out, people met the new technology with fear. There were articles at the time that said that trains were an unsafe mode of transportation, that maybe bodies would melt traveling at such speeds, up to 50 miles an hour. But when it comes to overcoming this fear, which we often do, that's when the opportunities of technologies are adopted and the promise realized. So with the printing press, despite initial fears, it led obviously to an increase in literacy across the globe, raising economic productivity and output across the globe, and it also created millions of new jobs across different industries, including an industry that we now know today as publishing. So generative AI is no different. And while it may cause some initial anxiety, it has tremendous economic and societal benefits. And it's accepted broadly that AI improves productivity. And we're at a very unique time in our history where there's actually a shortage of productivity growth. So if you look at the OECD countries, they're all going through an era of human history that we actually haven't seen since the Black Plague. Populations are declining, and especially in OECD countries, working age populations are declining in percentage to the population as a whole. So now we have fewer people who are going to be working to support more people who are either too young or too old to work. So we need productivity growth, and technology is where we're going to see that growth and where we're going to leverage it as a tool for that growth that we need. But this will impact jobs in the short term, especially in the way we work. A recent study by Goldman Sachs said that artificial intelligence could replace the equivalent of 300 million jobs, but the report suggests that this may also mean new jobs and a productivity boom. If I had one message for a lot of people in this room, especially the younger people who are at the beginning or the middle of their career, AI won't replace you. AI won't replace your job. You're not going to lose your job to AI, but a person that uses the technology more effectively than you, and the person that embraces the technology will have an advantage over you. And if you're resistant to it, ultimately you will be left behind. So just to illustrate it with a real-world study, Harvard Business School conducted a study of hundreds of consultants from BCG. And participants of the study were divided into groups. Some had access to AI technology, some didn't. Those who had access to the technology completed their work 25% faster. Now, these are complex tasks. These aren't automated tasks. They do complex work, consultants. And it wasn't just a matter of speed. Based on the results of this study, it showed that there are major gains not just in productivity, but in efficiency and overall performance for the consultants. So clearly, activities within AI's capabilities provides massive productivity and efficiency boosts for highly skilled professionals like many of you in this room. And unlike previous automation focused on routine tasks, that probably would replace jobs, AI augments complex jobs. And that's a key word for folks in this room. How can you think about how AI can augment your job? And that's what is important to really drive down on. In an article I wrote back in 2018 in the esteemed publication of Canada Lawyer magazine, not such a broad readership, but I wrote the article nonetheless. I suggested that we must stop looking at AI through the lens of jobs and focus on the impact on our work activities. So don't ask yourself with anxiety, oh my God, is AI going to replace my job? You have to be thinking, how can AI present more opportunities for me? How will it empower me to do my job better? And seek comfort in this, because if there's something AI can't do, that your training can and your experience can, is the ability to leverage smart intuition and experience judgment. And there are tons of articles out there about explaining how the advances in AI are putting a premium on judgment. So it's going to lead to a drop in the cost of prediction, and because AI can reason over terabytes and vast amounts of data, and you can use generative AI to pull reports on that data, but that data, that report, is just one function of important decision-making. The other key component is judgment and creativity. And that's at a true premium. And that's what's going to make you a better lawyer, a better financial planner, a better accountant, whatever your vocation. Ultimately, what's going to differentiate you in this age of AI is just that, you and your creativity and your intuition. So if I were to categorize 3 broad ways to use this technology, I'd think about 3 buckets. Take back your time, right? So how can you use AI to get through tasks faster? You can organize your emails, you can do summaries of transcriptions for meetings you no longer have to go to get the important points. You can summarize research. To use the example of Jonathan, put AI to work for you. Think about where AI can complement your work. Where should you spend your time around human connection, which may be at a premium, and put AI to work for you for the other things that it can cover. And lastly, to go back, if I can, is to skill up using AI. So I'm a lawyer. I've started to role play my negotiations with AI, right? So I know I'm going into a tough negotiation with a customer, an adverse party, and I actually, in my preparation, instead of thinking and reading, I say, what would a lawyer say if I said this? And if they responded with X and I said Y, how would they respond? And I pull data from the web to do that. I pull data from Microsoft because this technology crawls across our enterprise data to pull insights from previous agreements. And it is amazing how much it's improved my preparedness. I've identified so many blind spots around issues, and I'm just a better lawyer as a function of it. And of course, I'm skilling up around important topics around AI because I'm summarizing large research articles, and I'm drilling down on the points that I think are important to me as a lawyer, and I'm just getting through way more material faster, which is just upskilling my skill set as a lawyer. So thank you to UJA and, of course, the Professional Advisory Committee for having me. Happy to answer any questions or connect after around anything that we've discussed today.
Jonathan, can I ask you a question?
Of course you can.
Okay, I know as a lawyer you're not going to provide any legal advice, but my business, we hire external providers to write blogs for us for SEO purposes. If we were to switch to using, let's say, a ChatGPT or something to write content, do you see clients or internally at Microsoft any like copyright issues to just posting that online without, let's say, doing any edits to it or something like that?
Yeah, so there can be an entire session on the prospective legal issues that come of AI, especially around copyright. So it's interesting if you think about Microsoft. Now this is a Microsoft pitch, right? When you use Microsoft products, okay, to what extent are they going to protect you as a customer leveraging his products and leveraging his AI products, especially around, let's say, copyright infringement, right? Because that's where, in generating new content, it's pulling from material, some of it which may be copyrighted, and whether you can fit within an exception of fair use, et cetera, is to be determined, and we're still there. So, for example, if you're leveraging a Microsoft product, we actually defend and indemnify you to the extent you're being sued for any third-party claims, right? So that's a big deal. That's a Microsoft pitch. A lot of providers aren't doing that. But, you know, I think technology moves faster than law. So a lot of this is to be determined as we continue to evolve and continue to deploy technology. But, you know, I wouldn't let that disincentivize you from leveraging the technology. I would also train up your staff to leverage it, to do the blogging or the newsletters, et cetera, just to get through more content more quickly.
On that point, I have a question. Do you have any suggestions for best practices for businesses, business owners, with respect to policies with respect to their employees? We know that our employees are using it. Are there policies or procedures that we should have in place around them using it? Not that they shouldn't use it, but any quick policies that we should consider?
It's an interesting question, and I've gotten that question a lot. And I think AI, so let's think about, let's say, ChatGPT or Bing Chat. Everyone's like, oh my God, it's AI. It's just a search engine on steroids, okay? It's just leveraging AI to make for a better and more efficient search. So what policies do you have already around, let's say, web browsing, around leveraging Google? You know what I mean? Like, you don't have to revisit some of these policies depending on the tools they're using. Now, to the extent they're using those tools and leveraging enterprise data, right? So your proprietary information, your confidential information, and putting it into these tools, which may be free, depending on what, you know, you may want to look at what protections are provided through these tools and create policies around that. And so you can use, let's say, you know, a free ChatGPT application to, let's say, do research, but maybe you would, depending on going through their terms of use and what they do with their data, maybe you want to think, hey, you know, don't cut and paste some proprietary information that we have internal to our bank, to our firm, and pop it into the system, right? Unless you get an enterprise grade of that application, which will have different protections around use and yeah. Thank you.
Thank you so much. It's a fascinating and scary world, but you know, it's exciting. Maybe next year you guys can just populate some questions, and I'm joking because it's wonderful to see everybody and gather together, but you know, maybe we'll have the robot up here answering. Just kidding. So thank you so much, Jonathan. Fascinating. And of course, last but certainly not least is Marnie Pernica. Marnie, come on up. She is going to speak to us. Marnie's a partner at Airden Burles, LLP. She is going to discuss the topic of probate planning. Thanks, Marnie.
Hi, everyone. Thanks for sticking around. It's been an amazing morning, and I'm quite terrified to follow all of the speakers that I have, but I'm going to do my best, and I'm going to try and stay within time. So, probate planning. This is a topic that I could talk about all day. It's something that us as advisors, I think most of us in the room, kind of do as a bit of a, not a throwaway to client, because it's pretty important, but it's something that is a very good value add to clients that we talk about on a regular basis. Up until recently, again, it was a bit of a throwaway. It was something that we could implement that you could actually quantify the savings in a relatively simple way. It was a one and done with very minimal compliance. So what I'm going to focus on today a bit is we'll do some high-level discussion about what is probate tax, what are the typical ways that we implement with clients to avoid it, and we're going to go into what the new compliance regime is that will really affect the kind of advice that we're giving the clients. So again, I'm going to make a bit of an assumption here because I'm short on time that most of us know what probate is. Probate's the process of applying to court, getting back a piece of paper where the court effectively says, RBC, you can transfer the portfolio to the executor, land titles, you can let this executor sell the property. Those are really the circumstances where we're pushed into the probate world as a general statement, assuming beneficiary designations are done properly, et cetera, et cetera. The thing about probate, we all know it comes with a tax, an administration tax, rough numbers, $15,000 for every $1 million of assets. So when you're dealing with that 1% that Jamie was talking about, the numbers can be quite high. So we always want to help. So again, these are the types of assets where probate, you're going to get pushed into the probate world. Generally speaking, you're talking about real estate that's held personally, non-registered, personally held, either investment accounts or bank accounts. Those are generally the assets that there's no getting around it. You're going to be pushed into the probate world if you own them in that way. Again, these are the assets that don't. So as we talked about, those are the assets that are going to push you in. If you own shares in private companies, if you own assets in trust, if you own partnership interests, if you own anything where the third party who actually has to transfer the asset doesn't ask for probate, you don't need to obtain probate. So in Ontario, as all of you know, a very common planning technique that we employ is primary, secondary will structure. And effectively, we take the assets that need probate, I call it the primary will. You put it in the primary will. You take the assets that don't need probate, you plunk them into the secondary will. We draft our wills with such flexibility that it really is a determination on the date of death as to what assets are going to fall into what bucket. Oh. Where do I push? I don't know how to change this. Oh, there we go. So again, I'm going to just do a high-level analysis of the three types of probate planning that I typically put into place with my clients, separate and apart from beneficiary designations. So the first that we talk about generally is the benefits. So whenever I talk to a client, we always talk about the benefits over and above the tax savings. So there's an avoidance of delay in transferring assets to beneficiaries. There's an element of confidentiality that probate planning provides as well, because the probate process is a public process. You're submitting the will to court, and then someone can do a search of the court database and find the will. And a lot of clients don't like that and want to keep their estate plan private. So that's another way that we typically recommend probate planning. Again, it can minimize creditor, it can do some creditor protection if you're moving assets into a trust, and it can also do some limit family law claims against a deceased assets. It can reduce probate fees, and so again, trusts are often something that we use in the probate planning process. But again, and what I'm going to start focusing on once I go through the types of planning is the new rules and what that's going to mean on an ongoing compliance basis for our clients. The first and most common type of probate planning that I do is using corporations. Typically, this focuses on real estate, and effectively what we do is we take legal title to a piece of property, we transfer it into, I like to create a nominee corporation, so a brand new, clean, bare bones company. We take legal title, we plunk it into the corporation signs a declaration of trust, confirming that it doesn't own the property, has no interest in the property, it's just a legal title holder. You do not trigger any land transfer tax. You don't lose the loss of, you don't lose your principal residence exemption when you do this. It's effectively a tax neutral event, but now I have a corporation on title instead of an individual, and I've moved the asset from my primary will to my secondary will. Again, and I'm going to emphasize if I haven't already, in order for this type of planning to work, it is critical that your clients have primary, secondary wills in place. If you do this type of planning, but your client only has one will and they have a $100,000 bank account with RBC, if RBC forces probate, all of the assets that are governed by the will are subject to probate tax, which means even though land titles isn't asking for probate in order to sell the real estate, the executor has to swear an affidavit, and they're going to have to include the value of that property in the probate tax calculation. The second type of planning, and the bare trust planning with corporations, I'll just emphasize, you can also do it with non-registered investment accounts. It's a conversation for another day. Some financial institutions let you do it, some don't, but it is available for non-registered accounts as well. The next type of planning is the use of joint ownership. Again, this can be used with real estate and investment assets, and this is where someone just doesn't want a company, they just want to add their kid, they're in their 90s, I'm going to put my kid on title to the real estate. Doesn't really work as much with investment accounts because oftentimes the financial institution will say that you're triggering a gain by adding an individual to the account. But again, if you can do it, great. But there's a change in registration of the account or legal title to the property. The individual being added signs a declaration of trust, not my property, belongs to mom, and you're off to the races. Again, because there's been no underlying change in beneficial ownership of the asset, we do not trigger tax, we do not lose our principal residence exemption, and all the good things. It's kind of a tax-neutral event. But on death, RBC, because there's someone else on title, isn't going to ask for a probated will. Land Titles isn't going to ask for a probated will. They're just going to do a survivorship application. So again, you're able to move the asset without having to apply for probate. The last type of probate planning that I'm finding more and more common with my clients, and this is only available to clients who are over 65, are alter ego and joint partner trusts. The reason why I like these is because you can do non-registered investment accounts and real estate, and you can plunk them into a structure that financial institutions and land titles are comfortable with because it's a trust structure that's created under the Income Tax Act. So people understand these. They understand that if they're drafted properly, there's no tax consequences associated with the transfer in. We can transfer assets in kind, etc. Again, this only works for clients over 65. Very specific parameters that you have to be within in order for it to work. But that's kind of the other type of asset that I do probate planning with. So, as I said, it used to be a set it and forget it to a large degree. You did this type of planning and your clients walked away and there was no ongoing compliance. So it was a really easy sell. It's not overly complicated, it's not overly expensive, and the savings always, quite frankly, once you're in the $1 million range, outweigh the cost of implementation. With that said, the new compliance regime that the CRA has created has made this type of planning incredibly complicated and annoying to maintain. Now, I'm not the one who has to maintain it, let's be very clear. I still set it and forget it, but the accountants in the room know that their level of compliance has increased substantially, and the cost of maintaining the structure has increased substantially for the client. So it's no longer, I'm going to charge you X and you can walk away. It's going to charge you X and go talk to your accountant about what they're going to charge you every year to maintain this structure. So I'm not going to go through the details because I'm short on time, but there are two new regimes that are in place that affect this type of planning. The first is the Underused Housing Tax Act. Now again, this act was put in place to deal with underused housing. It was not put in place in order to deal with these types of structures. With that said, the filing requirements under this regime have brought bare trust planning into play. And effectively what I'm trying to say is, if you do that planning that I talked about with real estate, the trustee, so let's use the corporation as an example, now has a UHT filing. There is no tax associated with it, but there is a filing. The penalty for not filing is substantial. So as you see, the penalty for late filing, if it's an individual, so when I did joint ownership and I added my daughter on title, my daughter is the one who had the filing requirement, and if she doesn't file, it's a $5,000 penalty. If I did the corporate planning where I put a corporation on title and the corporation doesn't file the UHT return, I'm into a $10,000 penalty. These are annual filings, annual penalties. The second type of reporting that's now required for these structures are under the new trust reporting rules. Bare trusts are specifically brought into this regime. Returns are required. Again, not going to go through, all of the parameters of what you need to file. The accountants are going to have to do the work and ask the tough questions. However, again, there are penalties. So you don't file your trust return, you've got a penalty. So considerations for probate planning. I was always a big proponent of putting these plans in place. We did them all the time. With that said, it's really time to talk to our clients and have a closer look about whether this type of planning makes sense. A lot of it has to do with how they own their assets in the first instance and their age and stage in life. I just wanted to take you through a couple of examples where you can really see the effects of it. So before, when I had no trust returns, and let's say I just transferred the property to a Bear Trust Corporation, I now have a T2 return for the new corporation, I have a T3 trust return, and I have a UHT return. So I've created 3 new annual compliance pieces to my client structure. Take the situation where you just add title with your 2 kids because you want to treat them both equally. Again, both of the children now have a UHT filing. So I've added an additional level of compliance. The last one that I just want to highlight, because I do like alter ego trust, is when you transfer assets into an alter ego trust. When you do that, you've actually changed beneficial ownership, although there's no negative tax consequences to that. The consequence of that, though, is now Mom, who I'm using as my example, who didn't have any trust returns or UHT filings before, is now holding the asset in her capacity as trustee and not beneficial owner. So I have now brought Mom into the UHT reporting rules. So now Mom is filing a UHT return as well. So I've got Mom and 2 kids on title. I have 3 UHT returns, and the UHT return is per property. So it's not 1 UHT return per trust, it's per property. So you put your condo and your cottage in, and you've got 3 trustees, you have 6 UHT returns. So, with all of that said, probate planning still makes sense in the right circumstances. My kind of general advice to clients is if you own everything jointly and you're kind of in that age where it's, you know, if something happened, it's considered to be a premature accident. God forbid the plane goes down, that's a tragedy that if we have to pay a bit of probate tax, that's the least of our concerns. I really don't want to make clients jump over hoops. So with that said, I'm going to wind it up. I went a bit over, but hopefully there's no questions, but if there are, I'm here. Thank you.
Any questions for Marnie? I know she's running away. Okay. I think the moral of the story is hug the accountants and the estate planning lawyers in the room, right? So thank you all for being here. Before I get into my closing remarks, there was a ton of amazing food, and they've brought out some to-go dishes. So by all means, there's some beautiful rugelach muffins, all that stuff, let's make sure it doesn't go to waste. And so with that, thank you, Marnie. The November 2023 PAC seminar has come to an end. I would like to thank all of our speakers for their time and expertise. Again, thank you to our lead sponsor, Pear Tree Canada, and our breakfast sponsor, Richter, for sponsoring today's event. Thank you to the Jewish Foundation staff for their hard work in preparing for today's event, as well as the entire Professional Advisory Committee for their hard work this year. And to everyone here, we hope that you've enjoyed this morning's event. I know I did. The Jewish Foundation will be sending a follow-up email in the next few days and additional resources and information on claiming your continuing education credits. We, of course, encourage you to reach out to the Jewish Foundation or any of our PAC members to talk about how we can work together. Enjoy the rest of your day. Be well.